Hey guys, welcome to Market Minds, and in today's video we are talking about the basics of options and how options are traded. Alright, so before we start, understand that options is a game of numbers. Okay, it's a game of numbers. Alright, and before we start this, you should be familiar with derivatives. So if you do not know anything about derivatives, guys, it is useless to be in this class because you'll not be able to understand anything of options. So today we're talking about the very first part where we're talking about the jargons, option jargons. What are option jargons? Okay, so guys, this is the very first basic part where we'll be learning jargons. Okay, so without further ado, let's get started. So this is just an introductory note for all of us. Welcome to our virtual classroom where we make learning fun, interactive and engaging. Okay guys, so let's move to the next slide. So now what is options? Let's understand the options definition. A stock option gives an investor right but not the obligation to buy or sell a stock option agreed upon the price and date. There are two types of option, puts and calls, which is put, which is the bet a stock will fall, or a call which the stock will rise. Okay guys, I know this particular definition is overwhelming. Try to understand what exactly is options. All right, so in a very simplified manner, guys, let me try to explain you an option. All right, let's assume you're a real estate buyer. Okay, so you wanted to buy a property, so now we needed to buy a property. Okay, now we set a price of buying a property at let's assume 1 CR. Okay, so 1 CR is the price for which the buyer and the seller is agreed to make the deal. So let's assume Mr. B, this is a buyer, this is a seller. Okay, now we both have agreed to sell and buy a property at 1 CR. Now the buyer does not have the money to buy it at one shot, and the seller has agreed to take it in a partial payment, or maybe you could say as a token money. Okay, so options are nothing but the same way, not exactly, but it is the same way. Now let's assume you are agreed to buy a property at 1 crore, right? So now what you'll do, you'll pay a sum of premium saying that, boss, this property is mine, I'm going to pay you token of XYZ amount. Let's assume that XYZ amount is maybe 1 lakh rupees. Okay, so that is the premium what he paid for buying this property. He said that now you're not going to sell the property to anyone else but for me, but I'm just paying you a token amount of 1 lakh rupees as a token amount. That means you have to exercise as in you have to sell this property to me. So this way this guy will lose the obligation to sell. Okay, and this guy has an obligation to sell or buy. Now because this guy has all the right, whether he wants to buy or whether he doesn't wants to buy, the buyer has all the rights, right? So whether he wants to buy it, whether he wants to sell it, it is up to him. But the only thing is, the risk is what the premium he has paid, he has to lose it if he is not buying the property. It is simple, fair deal, right? So once you have given the token amount, let's assume the buyer changed his mind. Now he's saying that, boss, I don't want to buy a property now. So what the seller has to do, the seller can keep the premium or whatever you say this as token money. So options are similar, guys, very similar, but a little bit twisted there. Okay, so just understand the concept here. The concept is there's a buyer, there's a seller. Okay, so there's always two people in the market. Any market, there should always be two people, right? So one is a buyer, one is a seller. Here you bought a property worth of 1 crore for which you have paid a premium token amount. Let's assume this is a token advance, what we call in a local language, right? So token amount is how much? 1 lakh rupees, which we have paid to the seller, and the seller will not have an obligation to sell it to anyone else because you have already got into contract. This is a contract. Now this all is a contract, right? So that is what options are. So it all works on a contract basis, right? So you have an here something the seller will ask, boss, by when will you make the whole payment? It is a simple thing. When will you make the whole payment so that I can exercise my contract and I can give you my property? So the seller will decide, the buyer will say that I need maybe a week time or maybe a month time, depending on his convenience. So that is what here. So after 1 week, the contract gets expired, or maybe the seller will call and ask, so what do you want to do? Whether he wants to buy the property or he doesn't want to buy a property. If he says, yes, I'm buying the property, simple, he'll pay the rest amount and he'll buy the property. If it is not, the seller keeps the premium and now he can sell it for someone else, right? This is a simple, fair deal. Okay, the options are similar, guys. Again, I'm repeating, options are similar, but remember, guys, option is a game of numbers. Okay, options are attractive and options are highly risky. So I'll tell you why it is highly risky in the coming part. All right, so let's move to the next slide and see what exactly I'm trying to say. Okay, so now if you could see here, option gives the trader right to buy or sell a stock on agreed price and date. So as I said, there's a buyer, there's a seller, they both get into a contract. So it gives a right to buy or sell a stock at an agreed upon price and date. The same way, I am here saying I have one share and this is a buyer and this is a seller. We both agree on a contract and I am buying it and he is selling it. Okay, it's a very simple concept. So there are two types of options, call options and put options, which we are going to come in further. Do not worry. Once contract represent a lot size of an underlying stock. So I told you again, you should be familiar with derivatives. Without derivatives knowledge, you will not be able to understand options, because here it works on lot basis. Okay, so let's assume, what is lot? If you guys have forgotten, minimum order quantity, you can say. Okay, minimum orders. So let's assume a share of XYZ is at 20 rupees. So he just cannot buy 20 rupees in a derivative. There is a particular lot size that is 100. So that means he has to minimum buy his 100 quantity. That is a lot size. So that's what we call it as a lot size. Okay, if you guys have not you guys do not have any knowledge about derivatives or something, please do comment down. I'll make sure I'll make a basics of derivatives too. Let's move to the next slide. Now here we're talking about option jargons. Okay, the jargons of options are strike price. Okay, first is strike price, next is underlying price, then exercising of an option contract, option expiry, and option premium. Okay, so we have 1, 2, 3, 4, 5 jargons of options. Let's look one by one. The first thing is strike price. The strike price is the price agreed by both parties, that is buyers and sellers. Now if you remember, I told you something in the property case was, there's a buyer again and there's a seller again, right? Now we both agree to buy a property at what price? 1 CR, right? So we both agreed to buy a property at 1 crore. So this 1 crore, what we call it as? The strike price. Okay, so we call that price as a strike price in options. Okay, so now on a very simple thing, we'll see it on a option chain. Now see, this is Bank Nifty's option chain. So these are the strike price. I'm sorry guys. So if you could see here, these are all the strike prices. So each strike price has a premium. You see here, these are the premiums, which I'm going to come soon, but for just now, agree this one. So this way an option contract is exercised. So there are always buyers and there are always sellers. But remember here, calls can also be bought and sold. Puts can also be bought and sold. That we'll talk about in the later lectures. Okay, let's not confuse. For now, just understand strike price is nothing but the price momentum. See 33,400, 33,500, 6,700. So every strike price has a different premium. So now just understand what is a strike price. Strike price is nothing but the spot market price or a future price. Okay. Now let's assume this is a future price, right? So let's assume a stock is running somewhere around 35,100, but I know the stock will go to 34,400. Okay. So what I'm going to do is I'm going to buy a future price option, which is call option, at 689 rupees. Okay, but for now, let's not confuse here. Just understand this particular part is called as strike price. Okay, moving on to the next slide. Underlying price and exercising of an option contract. A very beautiful and a very simple thing. Okay, now understand this underlying price. What is an underlying price? So what is a futures definition? A futures definition is what? In a very simple word, a derivative is nothing but it is derived from an underlying, the price is derived from an underlying asset, right? So the same way here, sorry guys, I have a very horrible handwriting. I extremely apologize for that. The underlying price is at which the underlying asset is traded in the spot market, which is derivatives. And we all know that derivatives derive from the price of an underlying asset. So where does the option price gets from? From an underlying asset. What is an underlying asset here? If we go again, the underlying asset is Bank Nifty, right? Here, what is an underlying asset? Here, underlying asset is Bank Nifty. So all the prices here are derived from Bank Nifty's movement. Right. So this is an underlying asset. So here also it is a simple thing. Underlying price is derived from a spot market depending on what is its underlying asset. Okay. The exercising of an option contract. Exercising an option contract is an act of claiming your right to buy an option at the end of expiry. So you remember the buyer and seller. So guys, remember this, the buyer and seller will keep coming in every slide. So just remember these two people. Okay. So now just you guys remember that we bought a property as a strike price of 1 CR. So we both agreed to buy a property at 1 CR and I paid a premium of 100,000, that is 1 lakh rupees to this seller, in saying that I will exercise this contract on this particular XYZ date, or maybe a week later, I will pay you the rest of the 99 lakhs and I'll buy the property. So it is nothing but exercising of a contract. So it's the same way here. This expiry date is when? On an XYZ date. Now let's assume XYZ date is 1 week after. Okay. 1 week after coming into this contract, I'm exercising this contract, paying the remaining 99 lakhs and I'm buying the property. The same way here in an option, as a strike price I said, I have an obligation. The seller has already sold, has agreed to sell me the shares at this particular date. So that is, we call it as exercising of an option. Okay. So the contract happening is what we call it as exercising of an option. Okay. Now, usually we have 3 different types of expiry, guys. Okay. Option expiry. Always remember this. We have weekly expiry, we have monthly expiry, and we have quarterly expiry. Okay. So we have 3 months expiry. Usually this comes in commodities. Okay. Monthly expiry comes for stock options. And this we can see in index options. Okay. Now, do not worry about this one. I will discuss this about further. For just now, remember that we have 3 types of main expiries, that is weekly, monthly and quarterly basis. Okay. Now, if you could see here in an NSE website, we have 25th February, next week, 1 week, first week, second week, third week and fourth week. And we have continuously weekly expiries. Indexes have always a weekly expiry, guys. So remember that all these contracts have a weekly expiry. Every option is just like a derivative. It has an expiry day, whereas a settlement and exercise happens. So as we remember here, weekly, monthly, 2 months, 3 months. Okay. 2 months usually comes in derivatives, guys. So you can buy this month's contract or next month's contract. That depends on you and your comfortability of trading. Okay. So these are the types of options expiry, guys. So this is nothing much to crack your head as of now. More in the coming lectures, you'll have a little bit of complication. For just now, remember the very basics of what are options. These are the jargons of options. Okay. Now let's move to the next slide. Now, options premium. Remember the strike price I told you? So you remember the strike price I told you? What is the strike price? The buyer, the seller. Okay. First we are again here. Okay. So 1 crore is the price. What do we call this as? Strike price. Now remember, I am paying him 1 lakh rupees. So why did I pay 100,000 for him? This is nothing but a token amount. It's a premium, right? So you remember this particular stock. Now let's assume as this one market is at 35,100. Now what I'm deciding here is I know that the stock will rise up to, let's assume the stock will fall, okay, to 34,000 levels. Okay. Now what I'm doing is I'm going to buy a 34,000 put option. And the premium is 48 rupees. So what I'm actually doing is simple, guys. I'm telling the seller that on this particular day, the stock will buy at this price. So this is the price. That means we are exercising a contract of this one, and I'm paying a premium of 48 rupees in order to saying in a very simple way. What I'm doing is I'm saying that, boss, give me a Bank Nifty option stock at 34,000 rupees. Okay. So I know that I'm bearish on the stock. So what I'm saying is, boss, give me Bank Nifty's option at 34,000 rupees. When it comes there, I'm going to exercise my shares. That means I'm going to buy my stocks. So that doesn't mean you have to buy the stocks. So it's a very simple example. Just try to understand. Okay. So the buyer is saying that to the seller that I need Bank Nifty at 34,000 rupees. For that, what I'm saying is I'm going to pay you a premium of 48 rupees as decided here, 48.85. To be precise, 48.85. So what I'm going to do, I'm going to pay a premium of 48.85. I'm going to exercise my option, saying that on this particular day, on the option day, if it comes to this levels, I'm going to exercise my option, or else I can close it. So the biggest threat here is the seller always has unlimited loss, because you don't know how much the market will move, and the buyer has a risk of unlimited profit. Okay. So the buyer doesn't have a risk actually. In a very simple words, seller is having more risk, buyers are in more favorable, because buyer's loss is limited. What is maximum loss he can lose? It's 48.85 rupees. He cannot lose more than this. But seller, as he has sold his option from 48.85, that means his profit is limited. That means his profit is 48 rupees only. Okay. But his loss can be unlimited. So this is what we call as an option exercising. Okay, guys, I hope you guys have understood. Remember the strike price we spoke about earlier? It's the same strike price here. Every strike price has a premium. Okay. So guys, I hope you guys have understood the basics, jargons of options. If you guys have any doubt, please feel free to comment down. And if you have any concerns, you can always mail us at info@marketminds.com. And you can also call it as 6360560767. And also, if you are interested to watch this video in Hindi, log on to www.marketminds.com, or there's a given link below. You can click the link below. Okay guys, thank you so much for joining in for this first class. I hope you guys like this video. Please do like, share and subscribe to our channel. This will help us creating more content for you guys.